This is how you hedge against inflation, my friends. I'm going to show you illustratively how this works. Let's just dive into this. All right, so we got my man Wade Pfau. Why open a reverse mortgage before it's actually needed? This is an article from a few years back, but you can read it, and you can go to my man Don Graves here at Heckham Advisors Group. This is an older article, so we don't want that. But I'm a big fan of Don, a big fan of Wade, and they're going to talk all you can about reverse mortgages for sure. So Wade runs the Retirement Researcher website, retirementresearcher.com. I get no look, man. I get nothing. There is nothing for me in this at all, other than I want a place where more people are comfortable and satisfied in their lives, because you have work to do, my friends. You have work to do, because Jesus is Lord. And if you're not working on behalf of advancing the kingdom, we're regressing. We don't want that. And working some crappy old job where you're miserable, you're just hating life, that's not good. That's not what we want. Now, there's risks. I'm telling you, there's risk in everything you do. Shocking. All right, so let's go with what my man Wade says here. Nothing has changed since Wade's article. It's the same. So we're just going to show you something here real quick. All right, so here is your home value up here, and I think we're assuming a 2% appreciation on the home value. The home value grows by 2%. Your principal limiting factor grows by 4.5. Now, I'm not going to get into the weeds on how that works, because frankly, it's beyond me. And if you're going to go down this route and you want to have someone explain it to you, get the experts to do it. I'm not the guy. But anyway, so in this case, Wade says we got a $250,000 home. All right, it's going to grow by 2%, home inflation by 2%. The principal limit factor at 62 years old, you can only get 102,000 of that, about 41%. So that's going to be your starting line of credit, 102. All right, it's going to grow by the principal limit growth as an effective 4.5% rate. How do they define that? I don't know, but just look, again, you talk to the experts. I'm just telling you, this is a hedge against inflation. So here you are. Here's your home at 250. It's going by 2% a year. Here's your initial line of credit when you're taking it out at 62. It just grows. It grows at 4.5% a year. Now, this one right here is if you wait till later to take it out, and Wade talks about it, because if you wait till you're 90, you don't get as much of a value as if you did if you took it out at 62. It's just that simple. And on top of that, costs more. All right, so let's keep going, because I want to show you something else. What if interest rates rise? All right, so this example assumes interest rates stay low. But if interest rates increase, the value of opening the line of credit today would be greater. Rising future rates would help bring back some of the excitement about line of credit growth that was tempered by the October 2017 rule updates. All right, with higher rates would cause the effective rate to be higher so that the principal limiting factor grows. I don't know how that works, but look, I just know that Wade knows and I don't, and that's fine. All I know is we have a principal limiting factor right here at 4.5%, because that's based on low interest rates. With higher interest rates, we'll have a higher principal limiting factor. Okay, so let's see here. Rates increase the expected rate used to calculate principal limits on new reverse mortgages in the future. An example of this is provided in 1.3. The scenario is the same as in 1.1, except that later in the first year of analysis, interest rates permanently increase by 1%, which raises the effective principal limit growth to 5.5. So if you have an increasing interest rates, it will help with your increasing availability of your home equity line of credit. And so what you'll see here is your home. Here's your home appreciating at 2%. Your principal limit is this dark blue when it's starting at 62. And look at that, your actual line of credit is higher than the home value at some point when you're in the 90s. But see, as the interest rates increase, your availability increases too. It's the ultimate hedge against inflation. Oh my goodness. I don't get it, man. All this may sound too good to be true, and it probably is. Perhaps that is why it's difficult for people to grasp the line of credit growth method. I previously noted that the unused lines of credit work for borrowers, you and I, to the detriment of lenders. Such use of a reverse mortgage still exists today and would be contractually protected for those who initiate reverse mortgages under the current rules. However, I expect to see new limits on line of credit growth, especially as more people start to follow the findings of recent research on this matter. Yep. A round of such limitations came in October 2017, have weakened the case for growing line of credit, though the value still exists 100%. I could not agree more. I mean, look, this is increasing interest rates. It's even more of a hedge against inflation. This is with rates staying low. It's still a hedge against inflation. You're getting, in this case, it's 4.5%. I don't know what that's as of the date of this article. I don't know what it will be in the future. I just know at the end of the day, the line of credit growth is there. It will adjust as the interest rates adjust, which is freaking fantastic, which means if we have higher inflation and they idiotically raise interest rates to combat inflation, you're going to see a benefit to your line of credit growth. If they don't have higher inflation and rates stay low, it still grows. It still grows. Anyway, it's a slam dunk, man. Now, what are the risks? You have to figure that out yourself. But I'll tell you right now, check this out. I think there's a 2% cost of, so right here we got a $250,000 is your home. 2% will be the cost initially, not all the closing costs, but that's what you got to pay for the mortgage insurance premium. So you pay $5,000. If you wait till your house is worth $435,000 to initiate this, when you're 90 years old, it'll be, instead of $5,000, it'll be like $9,000. So you pay the money now to get it locked in. It's just that simple. There's just no argument against this, man. There isn't. I mean, the arguments are silly. I'll show you some arguments. Right here is not a silly question. It's a good question. While in spirit it may work, this is this guy, F430 Ferrari. I like F150 Fords better there, guy. Just goofing you. While in spirit it may work like this, but during the summer of 2008, pretty sure many home equity lines of credits were closed. That 100% that happened. It's not going to happen in a reverse mortgage, 100%. When this guy, Burt Painter, the bank doesn't lose because the Fed insures the loan against any losses in value, whereas there's no insurance like that on home equity lines of credit. That's why you pay, I think, against 2% in the front end and 0.5% on an annual basis on your home equity conversion mortgage. It's a mortgage insurance premium, which again, it's a user fee. If you're going to use it, you got to pay for it. So the government, i.e., you and I, the taxpayers, aren't on the hook. But yeah, you can't. They don't close them out like they did a home equity line of credit. Lots of good comments on here, my friends. All right, so right here, Rex. Again, not silly comments. I'm just like, dude, come on. If not used correctly, folks can run into big trouble. It shouldn't be done without understanding the nuances. Tread lightly. And I said, explain the trouble, please. And here is what they all say. You could lose your home to foreclosure. Oh, dude, this kills me. Your heirs could inherit less. Oh. It's not free. Oh. It could impact other retirement benefits. Oh. Come on. Reverse mortgages are complicated. All right. So let's talk about this here. All right. You could lose your home to foreclosure. The reverse mortgage doesn't put you into foreclosure. What puts you into foreclosure is not paying your property taxes. Try not paying your property taxes without a reverse mortgage, with your home owned free and clear, and see if you go into foreclosure. Just try it. The sheriff is going to be at your door, at least here in Georgia, to put you out if you don't pay your property taxes. It has nothing to do with the reverse mortgage. If anything, the reverse mortgage just frees you from that more so than having your home paid for. Why? Because you free up cash. You have all this equity, but you're not paying your property taxes. Reverse mortgage will transfer some of the equity to cash you can use for that. Such a weak argument. This is the Dave Ramsey argument, man. It drives me insane. Dave Ramsey cited this Washington Post article about these old people being put out because of reverse mortgage. And if you watch the article, if you read the article, it said they weren't being put out because of reverse mortgage. They're being put out because they didn't pay their property tax. The reverse mortgage had nothing to do with that. It's nuts. All right, your heirs could inherit less. Oh, they could. Okay, so I'm going to work a couple more years to make sure our heirs inherit more. Yeah, okay. I mean, yes, they absolutely could inherit less. Hate to say it, don't care. It's completely doesn't bother me in the least. In fact, frankly, let's be honest here. And I don't agree, this is not the argument to make, but I will make it anyway. I don't like this argument because it assumes things that I don't want to assume in the future. the debt that you're accumulating in reverse mortgage, because you literally are accumulating debt. All right, that compounds less than the market growth over time historically. I don't think you can make the argument that will happen. I don't know, but if we're going to look at historical numbers, taking your cash out of your home and spending that and allowing your investments to continue to grow, you actually left more with your heirs. So the evidence would state the other thing against this guy. However, I'm not sure what the future will be, so I don't even want to make that argument. But there's no evidence to state that you could leave less. There actually, the evidence is the other direction. All right. So again, 0 for 2. It's not free. You know what's not free? It's taking big retirement IRA distributions, have to pay tax on those guys. That's not free either. You know what is free from taxes is a home equity and reverse mortgage. Of course it's not free. Anytime you buy a house, anytime you refinance a house, anytime you take a home equity line of credit, it's not free. That's not free. I mean, is that literally an argument? Oh my goodness. It could impact your other retirement benefits. Yeah, we already talked about that. So it could impact them in a positive way. Come on, man. I need $25,000. I take it from my reverse mortgage, or I take it from my retirement accounts. I take it from my reverse mortgage. My other retirement accounts grow. It's like these COVID people. They don't know what they're talking about. It's just, I don't know what it is, man. Just people can't think. It's nuts. Reverse mortgages are complicated. Well, I agree with that 100%. That's the one thing I agree on. They are complicated, which is why you want to get a trusted advisor. Again, I like Don Graves. There's plenty of people out there you can talk to. I don't know if Wade Pfau is in the business of doing reverse mortgages, but I trust these gentlemen implicitly. So, but you might not. I do. Look, man, I mean, at the end of the day, yes, they are complicated. That I completely agree. That of all his arguments, that is his only one that is feasible, in my opinion. All right. Let's see. Reverse mortgage proceeds may not be enough to cover property taxes, homeowners insurance premiums, and home maintenance costs. Failure to stay current in any of these areas might cause lenders to call the reverse mortgage due, possibly resulting in a loss of home. The county is the one who will put you out. The county does by not paying the property tax. It's just that simple. I just, let's see. As of my man, just saying for people can really box themselves into situations before they realize that reverse mortgages are complex and upfront fees can be fairly significant. I mean, look, dude, I get it. And he says, keep the mojo going, Josh. But I appreciate that, Rex. But you're throwing arguments out there that are easily debatable, easily beaten down. And you're doing it because of ignorance. Remember, ignorance doesn't mean stupid. Ignorance means you just don't know. You don't know. And Rex does not know. And that's what ticks me off, man. All these people have just, trillions of dollars of equity that they could tap into, but instead they're grinding away at their crappy old jobs, ignoring the opportunity to hang out with their grandkids. It pisses me off. Because they've been fed this bill of goods by Dave Ramsey and others that reverse mortgages are somehow evil. Yes, they do cost something. You think the bank's not going to make money? They're loaning you money and they're not going to get paid back until you die or sell the house. That's a fact. That's a fact. That's going to have a fee in there, I guarantee. Welcome to the world of buying a house. There's a fee in buying a house. Anyway, so you can read the comments are fantastic because that's where people who know more than me, my man Sergio, the other guy on there, I forgot his name off the top of my head. You should read these comments on that video. I'll put it in the link because it's insane to me not to consider this. We had the guy who really turned against me on I don't know why, it's weird, man. He did all the analysis on reverse mortgage for himself, and he concluded it's bad for everybody. I just find that I don't understand. It's bad for me, so everybody's bad, and anyone who proposes these are bad. And I challenge the fact of whether it's bad for him or not, but whatever. And I'm just, look, man, it's kind of like saying annuities are bad for me, so they're bad for everybody. It makes no sense to me. You figure it out on your own, and you do it with going to a competent professional people who you trust. Know, like, trust. And so I'm introducing you to the product for you to know. All right, now you got to like the product, and then you got to find somebody you can trust to deliver it. I like Don Graves. I've just referred a number of people to him, and not one time has anyone emailed me back that guy's a salesman. Not one time. Now, that doesn't mean it can't happen. I don't know. But at the end of the day, not one person said they felt like they're getting a bum rush by Don. That doesn't mean you should go to him. If you want to go to freaking Sleepy Joe down the street, by all means. If you trust him, all more power to you. But I'm just saying, not to use this as a tool in your toolkit doesn't make any sense. All right, love to hear your thoughts.